Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus podcast. I am hosting solo today, as I do every other episode, with a very high-level guest on. And we are very lucky to have Mr. Ken Gee on the show. Ken's with KRI Partners. And he is the founder and managing partner of KRI, as a matter of fact. And he has more than 24 years of significant real estate banking and private equity transaction and also principal investing experience. Throughout his career, he has been involved in transactions valued at more than $2 billion, much of which has included the acquisition, management, and financing of various multifamily real estate projects. So, takeaway, listeners, is Mr. Gee here is a stud in the space. That's the only word that came to mind, and is very experienced. And we're going to get some great value out of this today, visiting with Ken. So, Ken, welcome to the show. I'm really glad to have you.
Well, thanks so much. I'm thrilled to be here.
Yeah, no, it's great to have you, and appreciate you visiting with us. So, I know there's a history behind KRI and what you were doing before KRI with Deloitte and Touche. If you would just kind of walk us through a little bit about, you and your background and kind of how you got to where you are today, and then give us a little more color as to what you're up to today.
Yeah, sure. So grew up in Toledo, Ohio. Got my undergraduate from the University of Toledo.
We're fellow Buckeyes. I grew up in Cincinnati.
Oh, there you go. There you go. Then I moved to Cleveland. I went to a Case Western Reserve University, got my master's degree there while I was working as a commercial lender and going to school at night. After I finished my degree, I went to work for Deloitte for the next 7 years as a CPA. I stayed on the tax side, doing a ton of M&A worked with a lot of private equity firms, and doing a lot of tax planning and due diligence and all that fun stuff. So it was during that time that the story it's kind of it's interesting because I already had my son. My daughter was very, very young. In fact, every night I would work at Deloitte during the day, then give my wife a break at night, and I'd do the middle of the night feeding. And my daughter and I used to, obviously I'd do the bottle thing. It was just her and I. Everybody else in the house is asleep. It was really cool, right? It's awesome father-daughter time. If you have a daughter and you're out there, you're a father, you know exactly what I mean. There's no bond like that bond.
Yeah.
What started happening over time was I would get frustrated. My mind, as you're sitting there very quietly watching your daughter eat, you'd start to your mind would wander. And I used to get frustrated after a while because I realized, I'm killing myself working, morning, noon, and night as CPAs do, and doing everything that I was supposed to do. Right. I went to school, got all my education, got a good job, but I couldn't figure out how that was going to get me to where I wanted to go.
Yeah.
I couldn't figure out how that was going to get me to a retirement that I wanted. I couldn't figure out how I was going to get myself in a situation so I could put my kids and my daughter through school without a ton of debt. Yeah. So I said, you know what, I got to solve this problem. So back then, now we're talking back in the mid 90s, right? This is a long time ago. So I decided, you know what, I spent 5 years as a commercial lender. My customers all had real estate. I spent 7 years at Deloitte, where they had a massive real estate tax practice. I said, Ken, the solution's sitting right in front of you. You just got to go figure this out. So I spent a bunch of money in a couple of years trying to figure out the real estate thing. Back then, there were no podcasts like this to help you figure it out. I think Carlton Sheets was the best, the closest thing to it. Yep. So I spent a lot of time. Finally, in 1997, I bought my first deal. Then after that, I bought another deal, bought a third deal. So they were all less than 30 units each. But here's where it really hit me. 3 years later, I sold those deals all at once, and I put $500,000 in my bank account from those three deals in 3 years. And I thought to myself, you know what? I have never had that kind of money in my bank account. So before, I couldn't figure out how I was going to get through school. Guess what? I now knew.
Yeah.
I couldn't figure out how I was going to retire. I knew now, right? This was obvious. Yeah. I need to be in the real estate space. And so now fast forward, 18 deals later, hundreds of millions of dollars later, here we are. We're now raising our second blind pool fund. Mm-hmm. We've finished our first $12.5 million fund, deployed all that capital. We're working on fund number 2. We've done a number of syndications, and now we're definitely off to the races.
Oh, that's so exciting. And it's a great story. Would you just, for the listeners, describe what a blind, I know, but I'd like to hear it from you, what a blind pool fund is? Yeah, no.
So most people, when they start raising money outside, so early on, it was me and my family. Then I found a partner, and he and I did a number of deals together. And then we decided to start raising money from people we didn't know. That's a syndication. And that's how most people really start to grow in the real estate world. So the syndicator goes out, finds a deal, locks it up, puts some of his own money down to hold the deal. And then he goes out and raises the money. Well, we operate now entirely in Florida and the Southeast. We don't do anything in Cleveland. If you know anything about that market, it's hyper competitive.
Yeah.
So, I submit an offer next to 20 other syndicators. So I said, you know what, this is crazy. I can't raise a large enough amount of money in a short enough amount of time to really comfortably do these deals. So I said, all right, we need to go rather than go find the deal, then the money, we need to flip this model around, just like they do in the private equity world. So we went out, raised the money first. We got commitments, legal commitments from investors that when I called the capital, they would send it. So then we went to the market and said, all right, guys, we got $12.5 million raised. Now we have to deploy it. The brokers now have some story to tell when they talk to sellers about us. They know we have the equity already raised. There's no equity raise risk. Yep. They know that, if the lender shorts us on the proceeds, we can make up for it because we have a fund to do that. So we became massively stronger buyers, and it's paid off huge. And so that's what a blind pool fund is. And that's why we went to that model.
Yeah. And it makes all kinds of sense, especially when you're talking about competing for offers. I'm curious, with your experience and your network and your history with private equity and whatnot, we're getting into these, let's say $20 to $40 million deals that we're working on, and we've opted to go with working on our relationships with institutional equity and bringing in big check writers that want to do at least $5 million, usually at least $10 million equity checks. That obviously doesn't give you that competitive edge that you mentioned necessarily, because there's still equity risk. But if you're solid in that relationship, then it kind of mitigates that a little bit. Those are very I guess they're different scenarios and different paths of getting equity for your deals. Can you kind of speak to the pros and cons of why you did what you did, and what the alternative might have looked like for you? Because I might learn something here as far as what we're up to.
Yeah. So nothing wrong with your business plan. It works, especially if you can establish that relationship. There are two things that I wanted to make sure that we were able to do. So I'm going to take you back. Remember, in 2012, the Obama administration passed the Jobs Act, right? That's why we can do what we're doing.
Yeah.
And the primary reason that was done was to give small businesses access to capital without going through the Goldman Sachs and the big markets. They could get capital from private individuals.
Yeah.
It also gave the little guy, I use in quotes, an opportunity to invest in deals like the ones that we do that before only rich people could do, right? Only rich people even knew about them. So now we had this mechanism whereby just you have to be accredited, right, to get into one of our funds, but the physician, the attorney, the CPA, the small business owner that is not super well connected in the what I call the old boys network, now they have access to deals. And so I wanted to provide an investment opportunity for those people, number one. The other thing that I wanted to do was maintain my own identity as a business owner, right? I mean, this is a business. This is what we do. And it was always my belief that if somebody writes, and you might correct me on this, but if somebody writes you a very large check, even if they quote unquote under the documents are a limited partner, right? Or they look like a limited partner in LLC, he who brings the cash generally makes the rules. So I didn't want to lose that control aspect of what we were doing because I wanted to, that's kind of the way I am. And I wanted to be able to sell when we were ready to sell because, the equity guy, his objectives might be different than mine. And I wanted to be able to control that. So nothing wrong with what you're doing. It works, especially if you have great relationships. But that's why I stayed in the space that I did. So we go out and we talk and we raise 100, 200, 500,000 at a time. And it works really well for us.
Yeah. Yeah, that does. It sounds like a great plan. And if you got it dialed and, you're obviously having a lot of success with it, that's a great thing. You're right. You do give up, I guess, some control of the deal in some situations.
Sure.
And just for the sake of the conversation, I'll just share like the sources that we're considering for our one deal, which is about let me just think about a $12 million capital raise. Are they're joint venture equity sources, and they're totally hands off as far as managing anything around the property. They're going to want I believe there were two conditions that they wanted some say in. One is disposition, and
totally
and
fair.
Other,
yep.
Yeah, and the other is signing off on an annual budget. So those two things aren't particularly painful, I guess, if you get it.
No, not at all.
Yeah, but if you're like you said, if you're in a situation where you want to sell or refi and the partner, the JV partner doesn't, like, I could see that getting messy. So what you say makes a lot of sense.
Yeah. You know what? Here's what matters. In the end, it matters what works for you, what works for me. If it works, let's keep doing it. I really enjoy it. We get testimonials from our investors all the time, and it's really cool to hear their stories. One guy was able to buy a house in Florida because of the money that we made for him. He wouldn't have been able to do that otherwise. I mean, that kind of stuff is really cool. So there's a story behind there's a reason behind every success story. So you can grow which much bigger check sizes faster than I can, most likely.
Right. Yeah. And again, pros and cons, right? Like this is going to give us a relationship or even a couple relationships that are going to want to continue to do deals with us. In fact, that's kind of almost a prerequisite here with these guys is like, they're like, we want the next deal. And so. Yeah.
You want to have a relationship with them. You don't want to be transactional with those guys. Yeah. No, I totally agree with you. Yeah. You're killing it, man.
Yeah. So, we're obviously excited about it because it's going to give us the ability to do a lot more volume and build our balance sheet a lot faster than we would have been capable of. Now, our capital raising game is, we started really as an acquisitions firm and raise capital kind of as needed as we would get deals under contract and moving forward. And, in doing so, in kind of approaching the game that way, we ended up basically just I lost my train of thought for a sec, but I think essentially our capital raising isn't quite as, certainly not as developed as yours. And it's, we can raise a couple million, 3 million on our own with our current CRM. And, for listeners, what you want to be listening for here, and we'll get into this with Ken a little bit. I think this is a really good direction, but you want to be listening for, number one, that you need to be raising capital really all the time. And it's something, if you look at my story and what I just shared, had we put capital at the front of the line, from the get-go, we'd be in a different place right now. But, listeners, you're going to want a CRM, you're going to want automated email, you're going to want a click magnet online that takes people to your landing page and collects info. And so that's really like your kind of your infrastructure of capital raising. Of course, you have an investor portal for actual deals that you're doing. But Ken's model is obviously quite different. He's raising capital that isn't deal specific. And so the investor is really, Ken, you tell us, but it seems to me like the investor would basically 100% be vetting you. I'm sure they want to know what kinds of deals you do and
Sure.
What kind of assets you're acquiring, but they're more like saying, we trust Ken. He's got a great track record. He's been doing this a long time, and he's promising these, or he's projecting these returns. So, we're a go, right? Like they're not visiting properties. They're not looking at underwriting. They're just,
Right.
they're just investing. So
Yeah, they're very. So what happens? So you're exactly right. The syndicator, the typical syndication investor, they like to be able to quote unquote kick the tires. They like to see the underwriting. They want to buy off on it, right? Because that's just the way some people are built, and there is nothing wrong with that at all. Interestingly, when we flip from that syndication model over to the blind pool fund model, most people said, Ken, your syndication investors will never follow you. And I'm thrilled to report, most of the times in my life when people tell me, nope, you can't do it. Nope, it's not going to happen. That just makes me bigger, more dug in to make it happen. So what we did when we did our fund is we made it look and feel very much like a syndication. Same fee structure, our fees are lower, everything else, because I can do more. If I can get 3 deals inside a fund, well, that's way more efficient, right? So the syndicator typically doesn't have the 18 deals and the 25-year track record for people to look at and say, yeah, you know what, this guy's done it over and over and over and over. Why would we think he's going to change now, right? When we have conversations with investors, some people say, hey, I want to be able to kick tires, look at the underwriting, and we're not the right answer for them. Maybe if we need a side raise, they're right. But the people that invest with us, they understand what we do. Our business model isn't super incredibly top secret. I mean, they're value add business model.
Right.
We just do the work necessary, and they know what we're going to do, and they know how we're going to do everything we can to bring certainty to those returns, and that's what they're investing in. And believe it or not, anybody that invests with you or a syndicator or me, they're still underwriting us as people and companies, because it is. Now, in my case, they're really underwriting me because they don't have a specific deal to look at. Now, we actually have a deal that we'll probably bring into our fund for fund number 2. So they'll probably have a little bit of a deal to look at.
Okay.
There was something else that you just said, though, I wanted to just highlight for everybody, and that is this capital raising process. It can't be transactional for you, right? You talked about the CRM and all these things. This process takes a long time because before someone's willing to write you a check or make a commitment to you for $100,000 or $500,000 or $1 million, they really got to get to know you. So that doesn't happen in 10 minutes, right? So people that are thinking that they want to raise money, they really want to start that process early and get out there and give the world an opportunity to figure out who you are and determine whether or not there's somebody that is right to invest with you. So just start early is I guess my message there.
Yeah. And there's things that you can do to jumpstart that when you're starting out early, like right out of the gate. I don't have any official affiliations with either of these resources, but a gentleman by the name of Hunter Thompson has a great coaching program, community, and some national events that everybody in his group goes to. That's just specifically about this, like raising capital. That's it. Like building your machinery and getting it to work. Another resource that I have referred a lot of people to that I wish we had used, to be honest, is called Good Egg Investments. And Good Egg will basically build out that entire system with all the integrations that they will create. You'll even get content for automated emails, and it's kind of a turnkey system for getting this going. And if you want to fast track this, obviously it's not cheap to do, especially this Good Egg. And I'm not sure about Hunter, but it's something to consider. You're going to be asking people to invest, like Ken just said, 50,000, 100,000, a few 100,000 at least, and giving them a system that is just dialed in right out of the box is something I think that's very worth considering. So again, hopefully this gets back to these guys that I'm promoting them on my podcast. But so yeah, Good Egg Investments, just like it sounds, and two wonderful women run that and created that, and they have their own fund and do a lot of deals too. So they're very hands-on, and like I said, I wish we had done that, because basically I spent months and months and months creating what they would have given us right out of the box. And, why reinvent the wheel if well, I don't know what it is, but let's say it's even like as high as like $30,000, $40,000. Think about, again, you're raising millions and millions, and you're getting these people into deals that are going to make you lots and lots of money, way more than that initial investment. So for listeners, I think it's just something worth considering. This capital raising thing, like Ken mentioned, and we'll repeat, is very, very much a relational game. It's a long-term, long game approach. And so you're basically creating all these relationships, and that's built on trust. It's built on credibility. And the tighter you are right away, right out of the gate with all your systems and processes, the better you're going to look, the better they're going to feel. Right. So yes, yeah. Any comment on any of that, Ken?
No, I mean, if you think about it, if you walk into a high-end jewelry store or a high-end clothing store, you have certain expectations, right?
Right.
Well, people that invest in our funds and your deals, they have investable funds, and that means that they're probably not poor. They're fairly wealthy, and they have some general level of expectation of service that they're going to get and how they're going to feel and how that whole experience is going to be. And that's interesting that you're talking about this topic, because we spend a great deal of time and energy making sure that everybody in our company understands what that service expectation is, and make sure that we're delivering that, so that you don't do all this work to bring in an investor. It's something as simple as filling out the subscription agreement. If they haven't done it a lot, everybody's subscription agreement's a little different. The exemptions are confusing. The rules are confusing. Yeah. So anything you can do to make that investor experience consistent with what they're used to getting, it really, really helps your brand. So we spend a lot of time and energy on that. We deliver our investments as well. Okay. I mean, we spend most time on that. Yeah. But most importantly, you don't want someone to come in, you talk them into investing, and then they have this horrific onboarding experience. Right. That's just not going to go well.
Yeah, absolutely. And they're not going to be repeat investors. I mean, your best investors are your repeat investors. You've already done the work. You've already established the relationship and the track record and everything else. And if you're not dialed in and things are slipping through the cracks and people aren't being communicated with the way they need to be and that sort of thing, it's, you're shooting yourself in the foot, in my opinion. So
agree. You're responsible for a lot of money. You need to really tighten things up. I'm with you 100%.
So A couple questions. So you're raising for your second fund right now, you said. With your first fund, I guess you've done 18 deals. I'm assuming that up until you guys started the fund, that most of those deals were individual syndications.
Yeah.
Yep. Okay.
Yep.
And with your first fund, have you done deals with that fund?
Oh, sure. We did a deal in Tallahassee. We did one in Daytona. We did one in Bradenton.
Okay.
The Bradenton one. So with a fund, it's very unlikely that you're going to need exactly the amount of equity that you've raised, right? It's just not going to happen. So to finish our third deal, we actually did another $4.5 million side raise to finish out that deal. And so we probably, it closed at about 12.5 million, but the reality of it is it was about 17 million that we, deployed through that fund. And fund two, we like to keep these funds. I feel very good at the $15 to $20 million range because it gives me the ability to bring diversity inside the fund. And because here's the thing about a fund, right? Syndicators probably pay a preferred return.
Yeah.
They probably get their money back. And then you have that waterfall after that, the profit split with your sponsor. Well, in our fund world, imagine our investors are now in 3 deals and our waterfall happens at the fund level. So they have to get all their capital back for the entire fund and their preferred return for the entire fund before we start participating in the profit, right? That's huge for an investor because what if one of those 3 deals didn't do quite as well as the other 2?
Yeah.
Well, I shouldn't hit home run, and then a single on the third, right? That wouldn't be fair. So it kind of averages it out. It's all super investor friendly. That's why I'm so excited about doing it because everything you look at from an investor's perspective helps them. We get better deals. We don't have to pay up to convince the seller to go with us over somebody else. We have funds already raised. We spread the deal costs over 3 deals or 4 deals instead of 1. There's so many benefits, and the waterfall is really backloaded. I don't know how you could paint a better picture for an investor, and that's what we try to do.
Sure. Are your funds similar in structure as far as the amount of the preferred return and the amount of back end and all that?
Yep. Yeah. We try to keep it super simple. We do a 6 pref, you get your capital back, and then it's an 80-20 split.
To
literally
the investor.
that simple. To the investor. Oh, yeah. Yep.
Yeah,
but you have to have all your money back and your preferred return at 6, and then the 80-20 split kicks in.
Yep. Okay. Got it. Is there any thought at all of, it sounds like you guys have, ample deal flow for these. Just curious if there's been any thought or conversation around investing with, as co-GP with other syndicators, that sort of scenario.
Yeah. So we would I would do a joint. It's a joint venture is the best way to do it. And
Sure.
we would certainly entertain that.
Okay.
Absolutely. Yep.
Yeah. Okay.
Absolutely.
That's great. So
if you got a deal, we're ready to go. No, nobody has enough deal flow. I will tell you that. It is really hard to get deal flow, especially in the hyper competitive markets that we operate in. And so that's why we're just trying to stack everything in our favor. And it's our network that really gets us our deals. It
Sure.
really, truly is. So if you've got a deal, let's talk.
Let's talk. Okay. Awesome. So like you mentioned, the Florida market is very competitive. There's a reason for that. There's a lot of people moving to Florida, a lot of money moving to Florida. Are you guys exclusively in Florida?
No.
Okay.
The first fund, we promised we'd stay inside of Florida. But the second fund, we've released that geographic footprint a little bit because we need to have the deal flow, right? It doesn't do you any good to make a commitment to my fund if I can't deploy your capital.
Yeah.
But having said that, I have to make sure that everybody's prepared with patience because we're not going to do just the first deal we find. So we're gonna look at hundreds of deals, whatever it takes. We're not going to do a deal that we don't really like. So usually it means we got to go outside our market, and that's what we'll probably do with the second fund.
Got it. What do you have any specific markets in mind?
We're looking at the growth markets. I care a lot. It's got to be a growth market. Remember, the company grew up in Cleveland, so Cleveland is not known to be
a growth market.
Not a growth market.
Losing
we
population.
figured out how to make money. Pardon me.
Yeah. It's losing population and
it is.
Yeah,
and so if you think about it, I mean, you've got a stable housing supply and declining population. Well, that's kind of a bear market, right? That's soft.
Yeah.
At least let's call it soft. So if you're trying to go long in a soft market, it just makes it harder. It doesn't mean you can't do it. It just means it makes it harder. Now take that value add business plan and put it in a market that has constrained supply and massive demand. That's all. Now it's a bull market. That's a very strong market. And then you put a value add strategy that we know we're going to get $300 to $500 of upside in rents. I mean, the returns are just explosive, and that's why we're in those markets.
Yeah. So for listeners, to kind of contextualize this a little bit, typically, an urban market, whether it's a primary market, secondary market, even a tertiary market, is either going to be a cash flow market or a appreciation market. And my friend Neil Bawa speaks really well to this, but Salt Lake City, where we are, is a great example of an appreciation market. Cap rates are very low, as low as anywhere in the country. And for this, a lot of the same reasons, just immigration and a lot of incoming, coastal money and institutional money buying stuff. Someplace like Cleveland that we mentioned, or Indianapolis or Cincinnati, are cash flow markets where the pricing is such that you can buy a deal and pretty confidently underwrite nice cash flow from that deal, but you're not necessarily going to get a lot of appreciation and equity growth. So Ken, your firm's gotten really good at the kind of the appreciation markets. Right. We've opted to go and into two markets, Oklahoma City and Columbus, Ohio, that we feel are kind of capture both aspects. They're both growing. They're not growing like Austin or Dallas or Tampa or Miami, but they're growing enough that we can underwrite the back end with a fair amount of confidence, and those properties are projected to cash flow well enough that we can pay the debt service, we can pay the expenses, and pay a preferred payment to either your kind of retail investors or your institutional type investors, if that's what they're looking for. So we won't deep dive into like market selection right now, but for listeners, I know a lot of you are kind of working on cracking the code on your first deal, or your second or third deal. And as you are doing that, obviously you need to pick a market, maybe two markets, in my opinion, at the most, that you're going to really deep dive into and start forming relationships with brokers and lenders and property managers and construction managers. So, it's important to choose your market well. There are markets that are kind of like hybrids between the cash flow and the appreciation role. So I just said a lot of stuff there, Ken, excuse me. I'm thinking of our broker in Columbus, who I'm on the phone with all the time. So you have any thoughts on any of that as far as cash flow versus appreciation and kind of how you guys approach it?
Yeah, so we do our best to get both, believe it or not. By the way, Columbus, the growing market in Ohio. So kudos to you for being in that market. Yeah, you're not going to go wrong there. So what we try to do in our deals, we try to underwrite so that we know we're going to get some cash flow on day one, right? We're not going to, it's not going to be a 10% cash on cash return, but it's going to be a decent cash flow. But here's what's really important about our business plan. We're value add. And so what that means is we're going to go in, make physical improvements. We're going to do management improvements. Yep. We're going to make that property, take it from where it is to where we think it could be. And we're going to do that quickly. We give you an example. The deal that we did, we closed in November in Tallahassee. Now this is July, late July, early August. We've already moved the rent roll $18,000 a month. Now think about that. It's only 84 units. That's a baby deal. It's only 84 units. But we're good. We moved that rent roll that much already. And that market is so strong, we have no concessions. So we've taken that. So that's how we create our value. by generating more cash flow. That's the number one thing that I love about what we do is of all the different investments you could consider making, stocks and crypto and whatever it is you want to do, I can't find an investment that has a more predictable, I can't say it's a perfect relationship, but a more predictable relationship between that asset's ability to generate cash flow and its value. Right. So the more cash flow I generate, the more valuable that's going to be, and someone else will be willing to pay for that cash flow stream. So we've gotten really good at it. And that's why you talked about picking one or two markets and really knowing it. That's what we've done. I mean, we know these markets like the back of our hand, and everybody operating in these markets knows who we are. And they know what our ability is, and they know what our reputation is, and all that kind of stuff. So we're kind of both, right? We're value add. The reality of it is the perfect deal, if you're really trying to maximize investor return, is to not pay a pref, add all that money back into the property as long as you can get more rents, because in the end, it'll actually pay more. Sure. The reality of the investor world is, though, they like to feel that drip, right? They like to get that mailbox money on a regular basis. And so, you just have to manage that. And then the score is when you sell the property or refinance it or whatever. That's always been the case for us for all the deals and all the 25 years that we've been doing this.
Yeah. Yeah. Fascinating. That's great stuff. What are your plans for KRI and your funds? Are you looking at doing more funds as these fill up? And so I guess kind of the 2 to 5 year sort of outlook for you guys are, and I've got a few questions about the market right now and what's going on in the market, but do you have any significant, I'm sure you do have significant plans.
we do. Yeah. I think some people refer to these as big, hairy, audacious goals, right?
That's right. BHAGs,
right? Yeah. So, I mean, we're hoping to be at $1 billion in 5 years. Current. Here's our challenge for us though, is we sell these properties. Yeah. So we don't hold on to them all the time. So it's harder even than you think to actually accumulate that much when you're selling at the same time. But, we're going to continue to do what we do. If we can return regularly 15, 20, 30+% annual returns to investors on a multifamily deal, that just makes me really happy to be able to do that. And, typically if you're successful in this business, people will find you. And so we believe that we're going to hit our numbers.
Yeah, that's so exciting. How far do you have to get there? I'm curious.
Yeah, we're on the way. We're probably over 100 million right now that we own. Okay. I mean, we've done quite a bit more in deals over the years, as you know.
Sure, you just sold a lot of them.
But it's we sell them.
Yeah, and that's pretty typical of the business model on these properties is that you're really like Ken said, the meat on the bone is really on that back end. And so, you're either selling or you're refinancing and creating that big windfall, that big cash event at the end of the transaction. So, a lot of people kind of idealistically think, well, I'll never sell anything. I'll just buy it and hold it. And that works really well if you're a solopreneur and you're doing just your own properties and you're self-funding and all that. That can work real well. But when you've got partners and investors and, people that are expecting returns, it's not necessarily realistic to hold. It's certainly not realistic to hold everything, I wouldn't think.
No. Investors like to see it turn because there's no better certainty than for me to say to an investor, we're done. The deal's done. We bought it. We did our thing. We sold it. Here's your money. You can't argue with that. Did I make money or not? There's no, is Ken, messing around with an appraisal or doing, you can't, I mean, cash in your bank account, you just can't argue with it. Yeah. And investors love that. Right. And if you're continuing to be successful, they're probably going to want to reinvest with you. So you got a little tax friction there, but I mean, come on, you got capital gains rates are relatively low. So, I mean, it's a relatively low amount of friction. So if you really want to grow your investor base, we actually had a guy do a testimonial for us He's a retired NFL referee, and
Oh,
he's
wow.
a super amazing guy. Well, and his first deal he did with us, he thought he called the guy that referred him in, and he said, "Hey, man, I think Ken made a mistake." He said, "Well, what do you mean?" He says, "Well, he sold this deal and he gave me my money back. And about 5-6 weeks later, because it takes a while to clear out the accounts, he said he sent me my money again." He said, his friend said to him, "No, man, no, that's the money you made." He said, "Oh my God, you got to be kidding me." He
Wow.
was just over the moon. So yeah, I mean,
Yeah.
it's those kind of stories. So when you're successful in his business, he still invests with us today, and he's continuing to grow with us. And we're changing his life because of that. And that stuff makes you feel good.
Absolutely.
It's hard to do that when you're holding their equity though 10, 15 years. You can't that investor growth cycle is just far longer when you're trying to do a deal like that. And that's why most people don't do that.
Have you ever done the anything with like the BRRRR strategy? BRRRR, obviously standing for buy, renovate, re-rent, refinance, and then repeat kind of thing, where instead of selling, you're doing a capital event in the way of a refinance.
Yeah. If you stick to the value add business model, here's what you have to be careful of. First of all, you're probably not buying an asset that was built, 5 years ago. You're probably buying an asset that's older. And when you go in, let's think about remodeling your house. You remodel your house 7 years later, what are you doing? You're like, this thing's dated again. I got to go do the kitchen again. So what I want to be careful of is after I do what I'm going to do, I don't want to outlive my improvements, because then I got to do it again.
Right.
And is there new capital there to do it again?
Right.
Probably not.
Yeah.
Right. You could maybe refinance and do it again. So you could. But typically when people do value add business plans, the ages of the assets are a little older, and you don't want to hold things too long, because nothing, the older something gets, the more risk that you take that you'll have issues. So we haven't historically done that. Otherwise, we'd have a lot more units than we do today.
Yeah. Yeah. Interesting stuff. Well, when you and I talked before the recording, we didn't have intentions of going into capital raising, but I guess selfishly speaking, for me, this has been incredibly valuable to kind of compare and contrast different approaches to do it, pulling these big deals off. If you're doing, a $4 million deal or a $10 million deal or an $8 million deal, those are deals that you want to ideally be doing, the retail investors, the $50,000, $100,000, $200,000 investors. And that works really well for that size deal. However, once you get to, 8 million, 10 million, $15 million capital raises, unless you're Ken and you're a beast in this space, and you have the track record, and all the experience doing this, it's prohibitive for a group like ours that's much newer than yours, to do it the way you're doing it right now, quite frankly. Where in comparison to us being able to go out in a single source and with a single relationship, meet almost all the needs. Back to the BRRRR strategy, it occurred to me too, like you're leverage constrained in a certain sense, in that you're only going to get 80% of the equity or somewhere around there, depending on the climate of the debt market, really. So you're not necessarily going to be able to access enough equity to do what you need to do for your investors. Just another side note on that, right?
No, that's a very good point. And actually 80% is pretty good.
Yeah.
Yeah. I mean, most of the stuff we put in place at 65, 70%, because, I think you said early on, I'm a CPA, I'm a lender by background, that just by definition, I'm conservative.
Yeah.
Right. So I'd rather take a point or two less in return and be able to sleep easier at night than, eke out every last ounce of debt I can on a particular deal. So yeah, we tend to stay in that lower level range.
Yeah. let's switch gears. We've got just a few minutes here left, Ken, but I want to ask you about kind of the elephant in the room right now. It's July 21st, 2022, as we're recording this, and the market's changed a ton in the last 3-4 months, mainly related to rising interest rates and lower leverage that lenders are willing to do than they were 4 months ago. And, you know, there's obviously there's a lot of talk about recession, inflation, and continual rising interest rates. So I guess, you know, how have you guys pivoted either in your underwriting or just your general business model as these changes have happened, and what do you see moving forward?
Yeah. So I believe that as we sit here today doing this, I believe there's massive buying opportunities up ahead.
Yeah.
There just is. Interest rates. Yeah, I wish interest rates weren't going up. But if you think about, first of all, just remember, we're doing apartments, right? We're not doing office. We're not doing medical. We're not doing storage. Any of those other asset classes, I can make a case for considerably softening demand. I can't figure out how to make it so nobody needs a place to live. That's why we are where we are, right? So now when you think about that, what do we compete with? We compete with housing. What happens when interest rates go up? People don't buy homes.
Right.
So now we're in Florida, they're a high demand market. We've already got demand outpacing supply by a lot.
Yeah.
And now we say, okay, rates are higher. Now nobody can buy a home. So what do? We just pile down more demand. So what does that do to our ability to raise rents? Now, whether people do it or not is a different story, but you have the ability to raise rents because now you're competing against another housing alternative that's going to be even more expensive. So rising interest rates don't concern me in terms of our ability to raise rents because we're going to keep up with that.
Well, there's the force of inflation that's pushing rents up as well, right?
So what happens, it's actually a cycle. I have this conversation a lot. If you think about it, our inflation that we're experiencing today is supply side inflation coupled with demand, right? So when COVID hit, we shut the lights off, everybody went home. Then we came out of COVID, we flipped the lights on full speed, right? It was a 3-way switch and it went on full bright. Now that supply chain takes a while. So we're waiting for the supply chain to catch up. So that created inflation right out of the gate, shortage on everything. I mean, I'm waiting for a car right now. Yeah. I've been waiting forever. So now what happens when we have really high inflation? The Fed can't deal with the supply side because they have no tools to deal with that. So they have to go try to beat down demand. So now they raise interest rates. That's how they deal with inflation. And remember how I just talked about interest rates affecting our ability to raise rents. So it isn't the inflation that gives us the ability to raise rents. It's the fact that interest rates go up, we have more demand, therefore we can raise rates even more. Now, what I think is going to happen, we'll see, because this podcast will be evergreen probably and sit there for a long time. But I believe that right now we have the Fed raising rates like crazy. We have crypto that's just killed everybody. We have the stock market destroying wealth. So all that wealth that was injected into the system during the pandemic is kind of getting sucked out of the system. And the Fed's not buying, they're not buying mortgage-backed securities and all that stuff anymore. So now we have demand going down while the supply chain is catching up. So we're going to even out here. I just don't know when it'll be. And then, of course, fighting that is the whole, war in Ukraine and gas and oil shortages. So it'll be interesting to see how it plays out. How does it affect us? We always do exit underwriting at a higher cap rate than when we buy in. Usually we go up a couple 100 basis points. So 2% is usually where we go.
For 5 years.
We're adding, we won't look at something unless it's at least $300 to $500 of upside in rents.
Yeah.
That gives me a pretty big cushion to defend against the cap rate going up before we get into a situation where, this isn't working out so well. So I build in it in my exit plan, and we have a lot of rent growth, and it's not growth long-term. It's growth that we get day one when we close our deals.
Yeah.
So I'm super excited about the opportunities right now, especially because some of the weaker buyers are kind of now sitting on the sidelines, and the lenders won't give them loans. They'll give us loans, but they wouldn't give the new guy a loan right now, maybe. So I feel like it's a great opportunity for a firm like ours.
Yeah. And, you've got adjustable rate mortgages that were written in the last 3 years or 2 to 5 years that are going to adjust, and you're going to get into some distressed situations, which should create these buying opportunities. Do you see any other factors creating buying opportunities?
Well, those are going to be pretty good ones. Those are pretty good ones.
Yeah. I mean, I guess my question is, like, where do you see the opportunity coming from? Is it economic distress, mainly based on adjusting rates on people's mortgages?
Yeah, it's going to probably be a combination of a lot of things. We've never heavily relied on that, but yes, that will create some opportunities. Okay. There'll be some distressed sellers out there. There will.
Yeah.
But what's more important to us in the markets that we're in, they're high demand markets. Right. And what's always made it difficult for us is we have less experienced people competing with us, and they have to pay up to get the asset, right? To get the deal. And so it makes it harder for us to get the deal. So we're welcoming less competition on deals.
I see.
Is what we're welcoming. We're always going to underwrite the same way. We just are. And we're always going to make sure that when we do a deal, we just closed out a deal in Bradenton, and we closed on it a month ago. We are currently getting the rents that I projected we would get in 5 years. Nice. But I knew that going in. You see, I'm gonna nail that kind of underwriting going in. Make sure we do our homework and your market. So we're always going to keep doing that. For us, it's really about less competition driving up price that when they really shouldn't.
Yes, got it. Yeah, makes total sense. Ken, this has been amazing. Unfortunately, we're pretty much out of time here. I guess last kind of discussion point or question for you is, and I ask this of most guests, is, for an investor that's looking to break into this space or is working on or has been working on it for a while, do you have any words of wisdom, words of advice for those folks?
Yeah. Well, people need to do their homework, right? Whether you're investing passively or whether you're going to be the operator of the deal, you gotta roll up your sleeves. You got to do the nitty-gritty homework and understand why things are the way they are.
Yeah.
That is the number one thing. We do some third-party management as well. And I talk to a lot of new people in the business, and just some people, they think the property manager is going to underwrite the deal for them and things like that. Please don't do that. It's not that property manager doesn't want to do it. Whether he has time or not is a different story, but you need to have it internally so that when you're sitting there in front of an investor, and you can ask me any question you want about any deal we have, and I'll be able to answer it. Yeah. We do the homework, and that's the number one thing. It's just, this is like any business. It's hard to get into. It's hard. You just got to work hard to get into it. Yeah. That's why when I wrote my book, I talk about most people should be passive investors. They shouldn't do what you and I do because it takes so much work to go figure out this business.
It does. It sure does. Tell us the name of the book and the basic gist.
Sure. Yeah, so it's multifamily real estate. It's a total game changer. I don't know if it'll show up on the screen. I wrote it. It basically covers two big topics. It's free, by the way. You go to kripartners.com/ebook. So it's easy to remember, kripartners.com/ebook. Yep. First part of the book talks about the number one question everybody has. They're probably even listening to this podcast. And that is, they're trying to figure out, they know everybody's making tons of money in real estate. They just don't know how it fits in their life. So I take them through that process to help them figure it out in a real way, right? So that it really does fit for them. Most people come to the conclusion that they should probably passively invest with guys like you or guys like me. And so now the second part of the book talks about how to vet sponsors, right? What should you be looking for? How, what kind of questions should you ask? How does the business work? Because I want people to make sure they're comfortable with whoever they invest with, whether it's us, whether it's you or anybody else. They need to be educated so that they can make good decisions about who they invest with, so that they can sleep at night, having their investments be in real estate. So it's kripartners.com/ebook. You just got to trade in your email for the book. And if you get tired of hearing from me, you can always opt out, but hopefully you don't. So
that's your funnel generator, right?
That is my funnel generator. Yes, sir. Yeah. But hopefully it's valuable. Hopefully you find some value in it.
Yeah, that's great.
These questions I face every single time I talk to new investors. Yeah. I face those very same questions. And that's why I decided to write on it.
Last question, Ken. What's the best way for an investor or anybody to get a hold of you?
Yeah. So download the ebook if you want, kripartners.com/ebook, or just shoot me an email, kgee@kripartners.com, and we'll figure out, what might work for you. We can get you all the fund documents and everything else. That's the best way.
So, and KGEE is KGEE for the listener.
Yeah. kripartners.com.
Yeah. GEE is spelled GEE. So, Ken, this has been fantastic. I really appreciate it. I think we got into some really great stuff here today. And, listeners, reach out to Ken, get that book, man. Like, it's free. Like, you need to be in this stuff. And then, that's something that you can go get and learn from. And you're going to have a whole different perspective on the business, every time you expose yourself to something like that. That's so educational. So Ken, thanks a ton. Really appreciate it.
Thanks so much for having me. I've enjoyed it.
Yeah, me too. So listeners, hopefully you got a lot out of this. If you did, we love a rating and review. We really appreciate that. It makes a big difference. And we will see you on the next episode. So take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.